Right now, somewhere in Shanghai, a logistics supervisor is staring at storage racks that once held roughly 5,000 tons of silver. Based on recent industry data, he's down to about 715 tons. That's reportedly an 86% drawdown. And sources say more than 50 industrial clients are demanding shipments this month. Some are even prepared to pay premiums just to lock in whatever metal remains. In October 2025, China reportedly exported around 660 tons of silver in a single month. That's enough to fill close to 22 double-decker buses. Where is all of that metal going? London. Why? Because analysts suggest London's inventories are thinning rapidly, and the global market appears dangerously close to a structural break. Here's what fascinates me. This pattern has surfaced 3 separate times in the last century. Same setup, same sequence, same outcome. And each time, silver didn't just rise, it detonated. We're talking documented surges of 2 times, 5 times, even 37 times in extreme historical cases. Let me walk you through the cycles. 1933. Government intervention sent silver to roughly 3 times its price in just 2 years. 1971. When the global monetary system shifted from metal to paper, silver multiplied by about 37 times over the following decade and a half. 2008. During the financial crisis, silver climbed nearly 5-fold in just 3 years. 3 separate eras, 3 distinct triggers, the same pattern every time. And right now, analysts believe we may be watching the formation of another cycle. I'm not a financial advisor, this is not financial advice, and I'm not affiliated with anyone mentioned. This is purely educational analysis based on public information. But this time, the acceleration appears faster, and the stakes seem higher than ever. Think of the market like a game of musical chairs. Stage 1. Everyone's moving, the music is loud, nothing feels wrong. Stage 2. Chairs start disappearing quietly in the background while the music keeps playing. Stage 3. The music stops, panic hits instantly. Stage 4. A scramble for whatever seats are left. And according to many market watchers, that's exactly where we are. The music just stopped, and there don't appear to be nearly enough chairs. Let's place this into historical context, not through dry theory, but through the exact moments when everything shifted. April 5, 1933, Franklin Roosevelt signs Executive Order 6102. This wasn't a suggestion, it was a mandate. Historical records show every American was required to turn in their gold at a fixed price of roughly $20.67 per ounce. There was no negotiation. You complied or faced severe legal penalties. But here's what many people overlook. The government didn't stop at gold. The Silver Purchase Act of 1934 followed immediately. The Treasury began buying silver at elevated prices. Why? Because controlling silver meant exerting influence over the money supply. And the result? Silver moved from roughly 28 cents to about 81 cents by 1935, nearly tripling in under 2 years. Not because silver suddenly became more useful, but because physical scarcity forced the price upward. August 15, 1971, a Sunday night. President Nixon interrupts regular television programming with an emergency announcement. The United States would no longer redeem dollars for gold. The Bretton Woods system, the backbone of global finance for 26 years, ended in one moment. Why? Because foreign governments were draining Fort Knox, redeeming paper dollars for physical gold. Official data shows U.S. reserves fell from around 20,000 tons to roughly 8,000. What followed? Gold climbed from about $35 to nearly $850 by 1980. Silver moved from approximately $1.29 in 1965 to around $6.70 in 1974. Then surged to roughly $48 by January 1980. Silver multiplied 37 times in 15 years. Some analysts argue the Hunt brothers distorted the 1980 spike. But in my view, they didn't create the cycle. They merely rode momentum that was already building beneath them. September 15, 2008. Lehman Brothers collapses. The 4th largest investment bank in the United States disappears overnight. Within weeks, the global financial system was on emergency support. Governments responded with unprecedented levels of monetary expansion. The Federal Reserve's balance sheet went from roughly $800 billion in 2007 to more than $4 trillion by 2015, according to public records. Investors noticed immediately. Physical gold and silver buying surged. Retail coin inventories vanished. Mints struggled to keep up with production. By April 2011, silver touched approximately $49.83 per ounce, rising from under $9 in 2008 to nearly $50 in just 3 years. Silver increased roughly five-fold. 3 cycles, 3 crises, same pattern, same outcome. But here's what should catch your attention. Each cycle appears to be happening faster. 1933 to 1935, 2 years. 1971 to 1980, 9 years. 2008 to 2011, 3 years. The tempo is accelerating. And the current cycle? Analysts believe it effectively began in 2020 with emergency monetary expansion. We're 5 years into it, and many experts argue we've just entered stage 3. Let me show you what's unfolding right now, because this isn't speculation. This is grounded in publicly verifiable data from exchanges, agencies, and commodity markets. March 2020, COVID hits. Governments worldwide reportedly inject roughly $20 trillion into the system within 18 months. Meanwhile, something else begins building quietly. Industrial demand for silver. Solar panels. Each gigawatt of solar capacity reportedly requires around 1 million ounces of silver. China installed more than 250 gigawatts in 2024, potentially 250 million ounces consumed by one sector in one country. Electric vehicles. Each EV uses about 1 to 2 ounces of silver. Global production is accelerating. 5G networks, AI data centers, technologies that didn't exist a decade ago, all of them require silver. Industry reports from the Silver Institute estimate global solar demand alone reached roughly 680 million ounces in 2024. But here's the issue. Total mining output, approximately 813 million ounces. Total industrial demand, more than 1 billion ounces. Analysts suggest a deficit of roughly 95 million ounces this year, and this is reportedly the 5th year in a row. Cumulative shortfall from 2021 through 2025, around 820 million ounces. Yet prices stayed suppressed. How? The COMEX paper market. For every real ounce of silver, there are reportedly between 100 and 400 paper claims outstanding. Some market observers note that large institutions have maintained significant short exposure, selling contracts representing metal they may not fully possess. This has reportedly kept prices muted. Then something changed. China, a long-standing accumulator of silver, suddenly reversed course. They shifted from major importer to heavy exporter almost overnight. Roughly 660 tons shipped out in a single month, reportedly the highest figure ever recorded. But here's what matters most. Those tons didn't appear because China had excess metal. Market analysts believe they surfaced because London's inventories were thinning, fast. The physical market was reportedly in full crisis. How do we know? Look at the lease rates. When lease rates erupt, it typically signals one thing. Holders don't want to lend their metal because they're not confident it will come back. Lease rates in London reportedly jumped from under 1% to roughly 39% annualized, believed to be the highest level ever recorded. Then traders began air freighting silver. Let me repeat that. Air freight, for a metal normally shipped by ocean because it's heavy and freight costs matter. When silver starts flying instead of sailing, it reflects urgency. The kind of urgency where buyers cannot wait 2 weeks for standard delivery. In late 2025, the U.S. government officially classified silver as a critical mineral. This wasn't symbolic. Section 232 tariff investigations followed, with potential import duties estimated between 15% and 50%, and the United States reportedly imports about 64% of the silver it uses. What happens next? Precautionary buying. Around 75 million ounces have reportedly flowed into U.S. vaults since October. Industrial users, investors, institutions, everyone appears to be scrambling because if tariffs land, imported silver could become 50% more expensive overnight. Meanwhile, in China, inventories appear to be collapsing. Shanghai Futures Exchange, roughly 715 tons, down about 86% from pandemic highs above 5,000 tons. Shanghai Gold Exchange, around 531,000 kilos, reportedly the lowest reading since 2015. And here's the signal many analysts consider critical. The Chinese spot price is reportedly trading at a premium, about $60.30 in Shanghai versus roughly $5.78 in New York. That kind of premium usually indicates the paper structure is cracking. Physical metal appears more valuable than paper contracts. When the physical and paper markets diverge like this, market observers often interpret it as one thing. There may not be enough real silver to meet demand. We appear to be in stage 3 right now. The music stopped. The scramble for chairs has begun. Some analysts argue China will release hidden reserves, calm the market, restore balance. Maybe. But here's the question. If China had massive hidden reserves, why would they drain public stockpiles by about 86%? Why would they export 660 tons in 1 month instead of waiting to sell at potentially higher future prices? The behavior doesn't align with that narrative. Either the reserves aren't what many assume, or they're being held back for strategic reasons that outweigh profit. Either way, the physical shortage appears real. And here's where it gets interesting. We are not yet in stage 4, but many of the prerequisites appear to be lining up. Right now, there are reportedly more than 800 million ounces of silver tied up in open paper contracts on COMEX. Physical inventory available for delivery, roughly 40 million ounces. That's approximately a 20-to-1 leverage ratio. If even 10% of contract holders request actual metal, some analysts believe the system could encounter serious strain. They may be forced to settle in cash. And when that happens, confidence in the paper market could evaporate instantly. Industrial users may panic. Solar manufacturers need silver now, not next quarter, not next year, now. Without it, production could stall. They'll likely pay steep premiums simply to keep the lines running. Then government intervention becomes possible. If silver hits $75 or $100, politicians may launch inquiries, demand hearings, push market manipulation narratives. They could even impose export restrictions. And every one of those actions could intensify the shortage because it signals something unmistakable. This is real. The situation matters. The government is paying attention. Hit subscribe right now, because what may come next could be one of the most important wealth events of the decade, and I'll be breaking down each stage as it develops, guided by historical patterns and current market conditions. Here's where some analysts believe silver may be headed. Primary scenario, $90 to $100 per ounce by mid-2026. That's roughly a 64% increase from current levels. This assumes continued physical shortages, potential U.S. import tariffs around 25%, and accelerating industrial panic buying. Analysts like Larry Leard reportedly target $75 by mid-year, $80 to $90 by year-end. Felipe Gales at BNP Paribas reportedly told CNBC he sees silver above $100 by the end of 2026. But that's what many consider the base case. There is also the possibility of something more dramatic. If COMEX encounters delivery stress, if governments restrict exports, if investors rush into physical metal simultaneously, some projections suggest $120 to $170 by summer 2026. That would represent approximately a 150% to 200% gain. Sounds extreme? In 1979 to 1980, silver ran from roughly $6 to $48 in 14 months, around a 700% move. In 2010 to 2011, silver climbed from approximately $17 to $49 in 10 months, about 188%. And here's the context many overlook. Adjusted for inflation, the 1980 peak of roughly $48 equals about $178 in today's dollars. We're at $58 right now. We haven't even touched the inflation-adjusted all-time high. Silver at $60 may not be expensive. It may have been artificially compressed for decades. So how should you think about positioning? You don't need perfect predictions. You need an understanding of the risk and a plan. If you believe China's vaults are truly close to depletion, and this pattern is reaching completion right now, consider focusing on physical silver, coins, bars, allocated storage. Some experts suggest avoiding paper ETFs that may not hold the metal they claim. Consider securing your position before potential tariffs arrive and premiums climb even higher. If you believe the shortage is real, but perhaps not as extreme as some estimates suggest, consider a balanced approach. Diversify across precious metals. Set alerts for key price levels, 65, 75, 90. Reevaluate as new information appears. If you're skeptical, that's completely fine, but watch the signals: lease rates, COMEX inventories, government actions, Chinese export data. The pattern doesn't require belief ahead of time. It just requires paying attention when the evidence becomes undeniable. Now let's be clear about what could go wrong. China could release off-exchange reserves we're unaware of. Demand could fall if silver hits $100 and industrial users find alternatives. The economy could contract and deflationary pressure could dominate temporarily. Government intervention could last longer than anyone expects. Those risks are real. But here's my perspective. Physical shortages don't care about paper prices. If there's no metal available for delivery, the paper structure may fail. And if the economy declines, governments will likely respond with more money creation. Crisis, printing, hard assets rally. That appears to be the historical pattern. As of early December 2025, silver recently set a new all-time high above $59 per ounce. Currently around $58, the metal is consolidating near these record levels. But that's not the main story in my view. China's vaults reportedly draining. London's lease rates believed to be at historic highs. The U.S. government has just designated silver a critical mineral. Approximately 820 million ounces of cumulative deficits, 5 consecutive years of shortages, air freight for a metal that should travel by ship, paper leverage around 20-1 on COMEX. These aren't random numbers. Many analysts see them as warning signals that tend to appear right before stage 4, right before price movements most people won't believe until they're already over. Remember the musical chairs analogy? We appear to be past the moment when the music stops. We're potentially in the scramble. People are realizing there may not be enough chairs, and the last person standing may pay whatever it takes to secure a seat. You asked me earlier which historical example this resembles most closely. Here's my answer. All three. We have elements of 1933's government intervention. We have components of 1971's monetary system shift. We have characteristics of 2008's financial panic and monetary expansion. All three patterns potentially converging at once. That's why this cycle could be larger than anything we've seen before. The question isn't necessarily what happens next. The pattern has revealed itself 3 times already. The question is whether you'll be positioned if it completes. If you found this analysis valuable, leave a comment right now. Tell me, do you own physical silver, paper silver, or nothing? Just write physical, paper, or nothing. I want to see where everyone stands. And if you know someone who needs this perspective, share it with them, because what may be coming could separate those who prepared from those who waited. Thanks for watching. I'll see you in the next